The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing show. I'm Victor McClure. I am your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How are you doing, Guy?
Pretty good. Happy Saturday to all. And, Victor, if you and our audience will bear with me for whatever reason, my voice can be real strong, and the next minute it disappears. So
what did that one say?
It's fading.
Said you're the worst voice on the radio or something? I go, are you crazy? He's got a great voice.
Well, like you always say, I mean, you could write about puppy dogs on the internet and get 100 people to tell you how terrible puppies are. I know.
You can find any side of any argument you ever want to go on the internet. That's why I'm hard when I'm going through internet research. I got to go, is that a good source? Is this?
I guess it's an age deal. I mean, we're in our 50s, but I just don't do the Twitter and the Facebook thing and all that. No. But I hear, no matter what you do, there's lots of trolls that'll come down. No matter what political side you have or religious side, you just get hammered out there.
I don't understand the Twitter. I don't get it. Now there's a new one. I don't know. Who cares what Kim Kardashian ate for breakfast or what she thinks? Yeah. I don't care what one celebrity on this planet thinks. Yep. One sports star, one celebrity, one politician. I can't even think that.
I don't even care what their opinion is. Absolutely.
Right. I don't care what they're thinking about that particular day. Who cares? But it is the deal. I think if you're you're a millennial when you've taken about 5,000 selfies, you haven't written a letter in your life.
You know what's funny?
You're a millennial.
Digress for a minute, and then we can get back to finances and fun stuff. But I think, United States is one of the few countries that hold their celebrities and their sports players up like royalty. If you go over to England, he's a ball player, he's a footballer, or they're an entertainer. They don't hold them in high regard like we do.
Oh, I think they do too, like the Beatles.
It's changing.
They saw them, they start crying. That's happened to me when I was.
That's what happens when
when
we get ready to give a seminar. Isn't that what happens?
They fall down and see.
Oh, thank you.
Yeah, absolutely. All right. Well, today we do this once every 3 to 7 months. We'll talk about nothing but annuities,
and we get a lot of requests for it.
Oh yeah, lots of them. And the reason why annuities are popular at this point is not because what you'll find is an anti-annuity person. Well, it's commissions. That's the only reason. Not really. The biggest reason is the economic environment we're in. You got a volatile stock market and you got low interest rates. And so people are looking for more yield from something. And so that's why in the last, 20 years, annuities popularity has gone through the roof.
Well, and to use an old analogy, we talk about the financial toolbox and having the right tools for what you're needing to do. And if you need income, if you want security and you want protection, I like to say I use an annuity. It fits perfect. It's like a socket wrench that you need a 3/4 inch socket for a 3/4 inch nut. A lot of other advisors, what they'll do is they'll use a crescent wrench. What is a crescent wrench? It's adjustable. It fits many different things that you can adjust, but it's not a perfect snug fit, and it doesn't grasp as tight, and it doesn't remove it or loosen a hard, tightened nut because it's not perfect. Annuities have their place, and if you're looking for income, if you want security, you want some market growth, but you do not want any losses, then it's a very good solution for you.
You just got to figure out what it is. Anybody that tells you, what's the one? Well, I hate annuities, and you should too.
Oh, yeah.
I'd rather go to hell than own an annuity.
Rather die and burn in hell than own an annuity. That's right.
That's like I said. The more they go overboard like that, no more that. There's not even valid advice. It's ridiculous. They're trying to sell you something else. That is the only reason. It's like me saying, let's say I'm a real estate guy, and I said, anybody invest in the stock market is a fool. It's a casino. Well, that's a ridiculous statement. It's not a casino, and owning real estate can't be your only option. And the one that hates annuities the most is just trying to sell you their stock program.
Are there some good places for real estate?
Absolutely. The good places for every one of those investments.
Absolutely.
So I don't like the anti-market people that just sell annuities and life insurance. They say that, that's just gambling. And real estate's bad. There's nothing wrong with real estate, stocks, or annuities, depending on your objective. Let's say your objective is, I want to produce the most income out of these life savings that I possibly could get. Well, the most income is going to come from an annuity. If you want something guaranteed the rest of your life, in other words, you want steady, predictable income until you die, there is only one thing in the world that will do that. That's an annuity.
And still maintain control of your money.
That's right. Some types of annuities you don't. But what you want to do is I normally talk about the bad. We're going to talk about the good, the bad, and the ugly. I normally talk about the bad and the worst ones, but I barely have any time to talk about the better ones.
We run out of time before we get to the good stuff.
I'm going to do it reverse this time. I'm going to talk about the reasons why people would like some. I'll still talk about the cons. You got to have cons in every investment. If anybody tells you, or it sounds like there are no cons, it's not real. These private investment deals all the time. Remember, on this show, we told you do not touch life settlements. I don't care if they're telling you Warren Buffett does them and everything else. And now what has happened? They're dying. I told you to watch out for these real estate investment things, especially if it's private placement, any kind of private investment. They're going through similar kind of lawsuits now.
Trading programs. You got to stay away from some of this stuff. That's not, though, me talking about you should only do this and that. For a private investment, if you know the principles involved and you have the access to the books and some more control than most partnerships allow, there may be okay, but it's more for wealthy people. Trust me, they want anybody. If you got $10, you got $10 million, they still want you. And so, but they're not going to tell you that. If you said, if a little old lady from Pasadena said, all right, all I have is $100,000 to my name, can I put that in your real estate program or your life settlement? They said, well, of course you can. You sure you can't get any more? A real advisor would never do that. And a real advisor is what you want to focus on. The litmus test for that, and we've talked about how to choose an advisor, a broker, a manager, someone to consult, someone that you can trust. Obviously, gut intuition has worked well for you your whole life, and you need to use that. But you have to make sure that they're licensed and they meet the compliance standards of all the products, of the universe of products, whether it's life insurance, whether it's annuities, whether it's stocks, perhaps even futures. Registered investment advisor is nice because you've got a fiduciary responsibility there. So if they meet that criteria, if they can do everything, chances are better, there's no guarantees, right? But chances are better that they'll guide you to a solution based for your needs.
That's right. If an advisor does just one thing, which I'd say 80% of advisors do.
It's unfortunate.
If you just do one thing, trust me, every answer to your solution, let's say I just do stocks and bonds. Every answer to every problem in the planet is stocks and bonds. Let's say I tell you I want no risk and I want to live off the income. Well, you're perfect for my managed program. Really? What part stocks and which part's bond? What if the thing loses 50% like the market has the last? Oh, we're sure that won't happen. We put safeguards in. What kind of safeguards? Well, we have pulled out before.
Well, you're going to be in dividend-paying
right.
stocks.
8-9 years ago, we got out of the market before it went down. Well, how do I know that's going to happen now? You can't have one tool, like using your toolbox analogy. It's just like having a hammer in your toolbox. A hammer works great when you got a hammer and a nail. But if you got to screw in something, a hammer's a terrible tool. You got to have all the tools.
And if you need to cut a piece of wood to an exact measurement to fit somewhere you're putting up some cabinets, I guess a hammer would eventually break the wood, but it's not going to be a smooth, nice cut.
You got to make sure you have it, and that's why only advisors, we like independent advisors, and we're not saying this just because we're independent advisors and have all the licenses.
Maybe a little.
But that's what you have to have. Think about it. It just makes sense. This show is called the Common Sense Investing Show. Does it make sense that somebody sells one thing and you're going to get advice on them what you should do with your entire portfolio? It does not make any sense to me at all, because they'll tell you, well, the bank, you don't want that. There's the crooks. Of course you need money at the bank. Anybody tells you don't need money at the bank, the stock market's evil, real estate's evil, annuities are evil.
Put all of your money into one thing.
They don't know what the hell they're talking about, and quit listening to them because they're just trying to sell you something. At least get advice like we give on this show. We're going to try to tell you the good, the bad, and the ugly. Like I said, a lot of people think it's fees or commissions. Guy, let me ask you a question.
All right.
If I hold an account for 1 year, annuity's going to pay more commission, right?
Yes.
What if I hold an account for 5 years or 10 years?
No question, it would be a managed account.
That's right. A managed account. Let's say you're paying 1 to 1.5% a year
Every
on
year.
a growing asset.
That's right.
That is the most fees produced in this business. Besides maybe some of the like universal life products, they pay pretty good commission.
Now, Vic, we've got a wonderful tool that'll help analyze what you have, where you need to be, and it'll make that selection easier for you.
Oh yeah. There's ways to look it up yourself, but we have all the tools here. Remember, if you'd like to take advantage of just a portfolio review, a retirement stress test, or Social Security or those always come at no charge to any of our listeners. There's no obligation. Nobody's going to high pressure you. Just feel free to call us at 972-715-2424. Again, 972-715-2424. Or you can always go to our website, ilovemyretirement.com. Remember, this is going to be the annuity show. We're going to get right into it after the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome to the Common Sense Investing Show. All right. Right now, remember, we're going to do this a little differently. I'm going to talk about annuities, in my opinion, that are the best. And then we're going to end up the show with annuities that are worst. Anybody tells you all annuities are bad, they don't know what they're talking about. But some, honestly, aren't. It's hard to find good in them.
Oh, yeah.
Some of them, I'll be real honest, it's hard to find that much bad in them. Okay?
It's hard right now, even with you just mentioning some of them, not to say, and then get right into it.
Right.
So.
I'm trying to go there.
Hold back.
Okay. If you want a CD alternative, a bond alternative. Now, why would somebody want a CD or a bond alternative? Well, go to the bank and check the rate, and you'll find out why someone would want a CD or alternative. 5-year CDs in America, even after the recent rise in interest rates, is a 1%. 5-year 1%. And by the way, that is a taxable 1% every year. Why would you want a CD alternative? Well, there's a fixed annuity would be a decent CD alternative, but there's two types of fixed annuities. There's a variable rate one and a MIGA, or a multi-year guarantee annuity. Fixed one, you'll find they get an enticing first-year rate. We're going to give you 6% this first year, then it's going to float. Trust me, it's never going to float. It's going way down. Everyone I've seen in 30 years goes straight down after that initial deal. So don't do those.
And I would add, there's some companies, and they're ones that Victor and I have been working with since 95 or earlier, that are A-plus rated, and they keep their rates the highest. And we know that because our clients have renewed their contracts with them every year for the last 22, 23 years. Right. And there are other companies, and they're usually the lower rated ones, or ones that are new into the field, trying to get into the fixed annuity field, which will do exactly what Victor's saying. As soon as they can hammer the rate down as low as possible, they do that. And it kind of mortgages their future, because brokers won't put clients with them if they're aware of it.
So just think about it. A high first-year fixed annuity, they're called CD-type annuities. It's just giving you an interest rate. They're very simple. MIGA is the simplest type of annuity there is, really. But it basically says, I'll give you 3% for 5 years.
Most CD-like.
Yeah, they're CD-like annuities.
Less the FDIC, right? We should say.
I'll give you 3% for 5 years, okay? The reason why anybody says annuities are terrible, they don't know what they're talking about. Well, what if I just told you a CD is paying 1%, 5-year CD, that's taxable every year, or a tax-deferred 3% a year, and it's fully guaranteed. So why would that not be better? Unless you need the money every year, the interest.
Some annuities will let you take 5 or 10% of your total balance, even in the 5-year fixed, without any
And most
issues.
of them will let you take the interest out anyway during that 5-year period.
As will CDs, right?
That's right. And so now the difference between a CD is there's a different kind of penalty. A CD penalty is going to be maybe 6 months worth of interest. A annuity penalty is going to be higher. And those type of annuities now, 5-year CD, you might have a 7-8% penalty by cashing out the first year, and sometimes it goes down every year. But either way, that's a lot higher penalty than a 6 month of interest, especially when your interest is 1% a year.
That's correct.
So you'll have a higher penalty, but you get a higher yield. So if you know I don't need anything more than the interest from it for 5 years, it kills every other thing. If you don't need any interest from it, you're just growing it, You just want a better CD alternative. Well, obviously, 3% tax deferred is a whole lot better than even 2% taxable every year. And on top of that, everybody knows you got $250,000 insurance from FDIC. You got a similar thing from the state of Texas on annuities, but banks only reserve maybe 10% of your money. Annuity companies are required to reserve 100% of your money. So it's arguable that there is similar safety. They still have a $250,000 insurance on either one, up to $250,000. It's not even arguable at all that you have more safety in a fixed annuity over $250,000 because they have 100% reserves when the bank only had 10.
Something to make a brief note on here. Because you're allowed to grow qualified money, not IRA money, qualified money tax deferred in an annuity, there is a 10% IRS penalty if you make a withdrawal before 59 and a half.
Right.
You don't face that in a CD. So it's, again, you have to, if you plan for these things, it's fine.
Let's say
but
you're
you have to know.
55 and you're going to buy a 5-year CD, it works perfect.
That's right.
Now, let's say I've actually talked to some of those 35, and they wanted to do the fixed annuity anyway. Because what you do is you do the math. All right, I'm going to do 3% for 10 years. What that is on 100,000, it's 134,000. Then I got to pay tax on it. Let's say it's 25% tax, whatever. So you got to pay 25% of the 35,000.
Right.
That's like 7 or whatever. So you end up 128, okay, after tax, but you got a penalty too. You got to pay a $1,300 penalty on it.
Unless you do a 1035 exchange.
Right. So you do a $13,000 penalty. So you end up with 115, 118, which would have been the equivalent on a CD after tax of over 2% a year. So it's still in that case was better to do the annuity, even if you paid the penalty. I don't recommend that a lot of times. That's for rare circumstances when somebody really is so petrified of the market or so petrified of a bond. You know, bonds have gone down, 6-8% in the last month.
Well,
so
and
people are scared of them.
As rates increase, and we certainly have indications of that, what's that going to do to current bondholders?
Right. And so that's what we'll talk about there is a CD bond alternative, a MYGA, a multi-year guarantee annuity or fixed annuity, is a really good choice with the rates the way they are. Now, if I can get bonds up to 5, 6, 7, 8% again, bonds might outstrip it. But usually your annuities are priced better than a 10-year bond usually.
That's right.
And so that's what you've got there. The next kind of annuity that's very popular and we recommend right now would be an index annuity. What type of person would want an index annuity? Let me tell you what type of person wouldn't. I'm 35 years old. Market risk does not bother me. I'm not retiring for 30 years. An index annuity is probably not something for you. Okay. Let's say we got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD. Don't hesitate to call us if you have any questions. 972-715-2424.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Today we're talking about annuities. We're trying to talk about the good, the bad, and the ugly. We're trying to talk about the ones are pretty attractive right now, then to go the ones the least attractive. For those of you listening, your index, your fixed, your MYGAs, not MYGAs, but your deferred immediate, the lowest one, in my opinion, is the variable annuity. Not because variable annuities don't have some benefits. Anybody tells you they don't have any benefits is not telling you the truth. They do have some benefits. They're just so expensive. In my opinion, you can't pay 4 or 5% fees to anybody. And what you were doing, if you're an anti-annuity crowd, you'll say, annuity fees are too high. Well, 1 out of 5 different types have that fee. All the rest of them, the most you're ever going to pay is 1. Most of them are 0.
And in fairness, because at the beginning of the show, we told you if anyone says, don't do this, completely throw it out, there's probably something to watch for. There are some good variable annuities. Number 1, you have to look for low fees. Number 2, you have to be willing to handle the ups and downs of the market because you don't want to buy the riders and all the guarantees and all of that because that's what burdens your cash value on your account.
And somebody goes, why would you want that? The best ones, Vanguard's got a good one.
Yeah.
TIAA CREF has
Teacher
a good
unions
one.
have
really
very good ones.
But they're basically just tax deferring the money, making it judgment proof. Remember, all annuities are tax deferred and judgment proof. Let's say you're a doctor. A lot of people like suing doctors, right?
Go figure.
And so a lot of them own a lot of annuities, but they might buy some of these low cost ones that they don't really protect your principal or anything else. It's just tax deferred and judgment proof. And for those I'm a small business owner. If you're a small business owner, the judgment proof part is something to think about.
It's attractive.
Because nobody can sue you and touch the money ever. And the state of Texas is one of the few states in the United States that's not only true, but there are no limits on how much you can protect with an annuity. You can have $100 million in an annuity. Nobody can sue you for it ever.
I got a question for you, Victor.
Sure.
I get this question all the time. Is it nursing home proof? In other words, can I stash all my money in annuity and have the government pay for a nursing home?
No.
That's right. You got to be careful.
Still part of your state.
That's right. And if someone tells you that it's arguable that they are,
no.
Either they don't know or they're not leading you the right way.
When it comes to the IRS, don't even look at the gray area, much less cross the dangle.
Absolutely.
It's crazy. Don't look. I don't go anywhere near it. I remember, 30 years ago, I owed him just a little bit of money. And this was when I was a kid.
I know.
I was in my early 20s. And I couldn't pay him right away. And if I owed him 12, I paid him 70-something at the end of the whole deal.
And it probably wasn't that long of a period of time.
It was horrible.
No.
So I don't mess with those guys. Okay. What's real popular? Let's say you are a 55-year-old and you're going to retire at 65. Let's say I want to get the most income from my money, period. Not the most growth, most income.
Can I throw in, let's say it's to make it absolutely perfect, maybe it's an IRA or qualified money?
Sure. What you've got is there's nothing, an index annuity income rider will pay you more income than almost anything else. A deferred annuity that you lose control of the principal, that will pay a similar income, but I have a real hard time relinquishing control of my money for my lifetime.
In other words, when you're gone, the money's gone.
Yeah, I don't want that. I don't want either. I can't change my mind later either with a deferred annuity.
That's right.
With an index annuity, you can. So that's where you hear those 6 or 7% guaranteed growth stuff, been around forever. That is a rider for future income. Your cash value is making up years of indexes, no down years. Now remember, it's a portion of those indexes. Nobody's going to pay you 100% of the S&P and guarantee never to take a loss. Now, they may pay a portion of the S&P and guarantee a loss, and that's what it is.
Now, I would mention this if I can. Right now, because they are working really well for income, and income is needed, and the fear is in the market, and they got the guarantee, and they pay so much, just like you see the negative ads, you're seeing a lot of positive ads, especially if you watch Fox News and the different financial Fox Business, the financial channels. You see a lot of people advertising them. They're probably good at what they do. I don't know if it's all that they do, but understand you're calling someone probably 4, 5, 6 states away. Once you call into a phone bank, they're going to go through all the numbers and dole them out to somebody back in your state to give you a call. We do this. We're very good at it. We've been doing them since 95, since they first came out, and would much rather have you deal with someone here locally that's established and been around for a long time.
Yeah, well, why would somebody want an index annuity? Let's say this. I've got $1 million. I would like $100,000 a year on it. You cannot do that in stocks. If you wanted $70,000 a year, you could not do that in stocks. Remember the withdrawal, the 4% rule? Between 3 and 4% is all you could take out. So that $1 million, you can get $30,000, $40,000 a year. What if you're a person? I need 80. I need 90. An index annuity is the only one that'll do it. Variable annuities have some income riders, and they're about 20, 30% less on average the income, but the fees could be 500% more.
That's right.
So they do have it, but just not good. Deferred annuities just have the same thing. At a future date, I'm taking a pension, except you lose control of the money forever, and you're locking in the worst interest rates in history. So stick with the index annuity on that side. We got a break coming up. Stay with us. If you have any financial questions, like a free information kit on anything we've talked about, call us at 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Remember, if you have any financial questions, we're talking about annuities today, so you'd like an annuity information kit, don't hesitate to call us at 972-715-2424, or go to ilovemyretirement.com. All right, we're talking about the good, the bad, and the ugly about annuities. Some of them can be really effective tools. Some of them make the salesman a lot of money, but don't make you much, because you cannot pay high fees to anyone ever, period. No system is worth 4 or 5% a year in fees. Some of them, 3%. It's hard. You start running into issues where you're not going to make it up in the market.
The problem is it doesn't look obvious. You don't see 4 or 5% written in red on the first page of the brochure. And someone selling those is very good and accomplished and has fielded hundreds of questions about the product. So they will make it sound very good, and you'll get all the good stuff and perhaps not all the bad.
Well, let's give you a reason why they produce more income. If you're a person, I want the most income out of my money, I want it consistent, and I want it flexible. So let's say 10 years from now, if CDs start paying 10%, I want to get rid of that annuity and buy that CD. Right. You can. They're always split. There's a difference between a penalty and liquidity. If I was getting a 10% CD, I wouldn't mind paying a penalty to get into it.
Right.
If I had to.
Right.
If I had to. And fees on index annuities range from 0 to 1. 0 to 1. If you'll find anybody that says annuity fees are ridiculous, well, 0 to 1 ain't bad at all.
Nope.
I mean, so it's 0 to 1. So income, I'll give you the example of why it let's say I've got this $1 million. It works percentage-wise if you got 100,000 or 100 million. Well, millions is easy math for me. Let's say you got a 7% guaranteed income rider. So I got $1 million. In 10 years, I know for income it's got to be worth $2 million. Let's say your payout factor at 65 is 5%. So $2 million times 5% is what? $100,000 a year. Well, think about it. You put $1 million in, you get $100,000 a year guaranteed for the rest of your life.
Forget about the guaranteed, Victor. Think about it. If you're listening out there, out of all the investments you've got over the last 10 years, how many of them have doubled?
Oh, I know. People will look at, for some reason, they forget the down year.
Right.
Like 2008, it's gone straight up. I've got a 10-year return of 15% a year. I go, really? You know what the 10-year return on the market is?
4?
It's not much because of that down year. Well, so an index annuity income rider will give you more income, because think about it. You put in $1 million, you're going to get 10% for life by deferring it 10 years. By deferring it 5 years, maybe get 60 or 70,000. That's still a lot more than the 4% withdrawal rule. In other words, $1 million, I can take 4% a year out. Well, 40 grand a year and 100 grand a year are totally different. Some of them might double to 200,000 a year if you go to a nursing home or need a long-term care. Some of them have long-term care riders where they come to your house. Well, if your objective is income, what the heck could be more than that? I mean, 100,000 a year on $1 million.
That's right. And for clarity's sake, the old immediate annuities where you gave them money and you got a payment for life, your money didn't earn anything, right? Because there wasn't a cash column. These, your cash is there. The withdrawals come out annually, but they're earning money every year. You go up when the market goes up, and you don't go down when it goes down.
Yeah, the cash portion earns up years, no down years, while you're getting your 100,000 a year in that example.
That's right.
Your balance is still earning up years of indexes, no down years. Where some people get in trouble, the annuity salesmen get in trouble, they're not being straight with the people. They'll
as far
say
as expectations?
and they'll let the people assume that you're getting 100% of an index and not taking a down year, when it's always a percentage of the index.
Good point.
We've done rolling 10-year periods on all of the annuities we offer. You know, they'll do 30 or 40 years with a rolling 10-year periods. And the worst they've done is in the 3 to 4% range, but the best they've done might be in the 6-7% range. So if you're realistic going in, remember, this is CD type of safety. This is a safe product. Fixed index annuities are safe. Well, 4 to 7, is that okay? How about 3 to 6? That's fine. But you got to know that's where you're not going to get disappointed. I've had people say, well, the market made 10 and I got 4. Or got 6, whatever the number is. I go, well, remember, this is fixed income. CDs have averaged about 1.5%, 2% for the last 15 years. Bonds, 10-year treasuries have averaged maybe 2.5%, 3%. The stock market, 15 years, has averaged 4.24 with dividends. And so is 4 to 6 without any market risk and that huge 100,000 a year in income worth it? To some people, yes.
I got a question for you.
Sure.
What's the reserve requirements?
100% on all fixed annuities.
Did you hear that? 100% on fixed annuities.
It's kind of like a bond. Let's say you buy a corporate bond. The corporate bond is just a promise for some company to pay you back interest payments and principal back at a certain date.
You're loaning them money.
An annuity company is similar. They agree to pay you interest and your money back at a certain time, minus a penalty or whatever early. The difference is there is zero reserves with a corporate bond. They don't have the money set aside.
They don't have to anyway.
That's right. If they go out of business, you're SOL, right? In an annuity company, they have 100% reserves. The average is about 105%. And so if something happens to them, the money's sitting there, and if they only invest these, they have to invest these reserves safely. If they do not, the rating agencies will destroy them. And so you've got a safe reserves. Anything happens to the insurance company, the money's sitting there, and the 250 insurance. It's real tough to beat the safety. So they can kill everything on income. It's virtually impossible to recreate that kind of income with a stock account or a bond account. Now, if bonds get back up to paying 7, 8%, 9%, they come back into play as a viable investment again.
And if you're 35 years old and you're going to need the money for your kids' college in 6 or 7 years, this wouldn't be the right thing, no matter how good it sounds.
That's right. All this time of year, my throat gets entirely.
I'm with you.
So you get up years, no down years of the indexes. You get a guaranteed growth of, say, 6, 7%, which translates into a life income. Just be realistic. It's fixed income. It's not stock market where you're going to make 20% a year, but you're not going to lose. And that's really important to a big piece of the population out there. We got to break on us, folks. Stay with us. Remember, have you any financial questions? Don't hesitate. 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. I am alive.
Got a throat transplant. Her voice.
I thought I was going to cough myself to death just a minute ago. Like I said, this time of year, my throat gets completely dry. I have to have water next to the bed. I'm like, I've turned into one of those old men that take a bunch of pills and have water next to the bed all the time. Dang it.
I'm not going to say a word.
All right.
I have no idea what you're talking about.
All right, we're talking about annuities today. The good, the bad, and the ugly. The ugly about an annuity, let's say all annuities, the worst part. All right, it's the last segment. Let's talk about it. Well, penalties. If you cash out early out of an annuity, you could face a penalty. Now, there's some without penalties and all that stuff. The majority of them have penalties, though.
And a rough rule of thumb, and it changes, and there's 100 different companies, but it would be a 10% penalty. Let's say it's a 10-year annuity, and it goes down 1% a year. So the next year it's 9, then 8, and 7, and 6, and 5. But you can, well, most of them, you can always take out 10% of the total value of your account before you would incur any penalties. So what's the key there? You have to plan.
That's right. If you use it for a certain amount, like retirement money, let's say you're 58 years old, you cash out a retirement plan, you're crazy. You've lost your mind. You're going to lose half of it in taxes and penalties. Well, that kind of money, I can put a 5-year annuity or 10-year annuity because I just want income from it in a future date anyway, right?
And if you're going to use it for your required minimum distributions at 70.5, which is what is a forced income stream anyway.
Right. And think about it. If you've got, if I know I'm going to use this money for, let's say I'm going to buy a vacation home 2 years from now, don't put that in an annuity. Keep that in liquid stuff, okay? You probably want to keep it in cash instead of the market, to be honest with you. But remember, anybody that tells you annuities are bad, stocks are bad, real estate is bad, is just trying to sell you something else. Because there's nothing wrong with any of those investments. I just prefer not to pay high fees. So in my personal business, personal, practice, I don't like variable annuities because the fees can get over 5% a year. And if you read the prospectus on these things, they can go up another 1 or 2 higher than that.
That's right.
So you imagine the market made 4.24 with dividends and no fees for 15 years, and you're paying somebody 5 or 6% in fees. I can't do it. And anything I can't do, I sure couldn't offer to someone else. Now, they did have a couple of them about 5 or 6 years ago. I had one thing that was pretty neat in it, and it was a little bit lower fees, but still, high fees don't do anything except for one side of the table gets rich, the other side's go broke.
Now, if I could step in here, if you have a variable annuity, don't feel bad. We're not trying to hammer you out there that have them. There's some good ones, number one. Number two, I can't tell you how many people that Victor and I see through the course of a year where what we do for them is we go through that thick 200-300 page prospectus that you don't want to and probably haven't gone through to isolate, let you know what the fees are, let you know what the benefits are, because for those fees, you're usually buying a rider, an income rider, a death benefit, a living benefit, and it's all confusing to a lot of folks, but we can go through those and we can isolate them and at least help you understand. And if you're in a position where you can 1035, which means come out of, let's say, a variable annuity and perhaps get into a better fixed annuity that's more suited for you, we can also do that. If it's not appropriate, we will absolutely tell you, listen, it's not appropriate, but here's the best way to make what you have work.
I'll tell you what, I don't think it's 1 out of 10. And a lot of engineers call me because I'm a former engineer, right?
Right.
Maybe 1 out of 10 will actually know the fees they're paying.
Oh,
in
you're
a
right.
variable annuity. The ones that do, sometimes your engineers, they'll know the mutual fund cost. No, not the mutual fund, the insurance company cost, but have no idea on the mutual fund cost. So at least you want to know what you have.
Or expenses.
That's right. If you can find something, let's say your objective is income, and you can find something that guarantees you 30% more income, and you pay a 0.5% fee instead of a 5% fee. Is that worth taking a look at? You're dang right it is. But what if it's paying you less income, and you really need that last piece? Well, you got to stay with what you got. Even though you might not have purchased it from the beginning, you stay with what you got. And so right now, if you're looking for income, nothing will produce more income than I could think of. I can't think of one thing that will produce more income than an index annuity income rider.
And we would
I can't
challenge
think of one.
anyone listening. If you
I'd
can
like to
think
find
of something, please call. We'd like to
Think about it.
have that discussion.
Yeah, you got $1 million. You defer it for a few years, 70 to 100,000 a year. You can find me anything that's close without a bunch of risk. Remember, this is no risk in this transaction. I would love to see it. I challenge any of those guys that say they hate annuities and why you challenge them to say, what if a person has this amount of money, they need this much income? What are you going to do? Because if you got $1 million and you take 7% a year out of your stock portfolio, trust me, that's a death spiral. It will not work. You put one down year like we've had twice in the last 15 years, you will go broke. And you'll be, eating cat food like my normal saying when you're 80. You don't want that possibility. So the most income, index annuity income riders are fantastic. CD alternative, MIGA or multi-year guarantee. It's like a CD type. If I can get 3% for 5 years and the bank's paying me 1%, I'm definitely interested. If a 5-year bond is paying me 2%, but I've got a lot of risk in a bond. If interest rates go up, bonds go down. You don't have interest rate risk in a MIGA or a multi-year guarantee annuity. So those are good for that. Variable annuity, can't think of much good on those. A fixed, an immediate, which is an old school annuity. You just give them amount of money, they give you a life income. Those are okay if you want the most simplest form of annuity, but the problem is you're locking in the worst interest rates in the history of man. And so I don't like doing that. Now, once interest rates go back up, those immediate annuities and deferred annuities will become an option again. If you have any questions or like a free information kit about annuities or about the stock market, our managed program, our retirement stress test, don't hesitate to call us at 972-715-2424. You can always go to our website, ilovemyretirement.com. Again, 972-715-2424. I'm Victor McClure for Guy Allert. We always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice